finance, a la shmup. What are the return dynamics of investing in stocks versus bonds? Well, here's risk, and here's reward. Take more of this, and you get more of this, but also this. All right, stocks, they're risky. Well, they're risky in the short run anyway. Here's a chart of the S&P 500 since the late 19th century. Peaks, valleys, peaks, valleys, peaks, valleys. It goes up a lot and down a lot, but over time, it goes up a lot. In fact, over time, the stock market has gone up by about 10% a year, give or take. And there were long periods of time where the market did way better than 10% and long periods where it did way worse. And don't forget, you have to include dividend and dividend reinvestment when you do these calculations. All right, so you can't invest in the stock market with a short-term view, really. It's like navigating a ship with a magnifying glass instead of a telescope. If you're going to take on the risk of the stock market, well, you mitigate a lot of that risk by just committing to own your basket of stocks for a very long time. If you do, and history continues to repeat itself like a bad Thai food dinner, well, then you'll double your money about every 7 or 8 or 9 years, something like that. Got it? Okay, the bond market's a completely different animal. Here are yields in the early 1900s, and here are yields around World War II, and here are yields around the 70s. Well, note the skyrocketing numbers here as the Jimmy Carter administration tried hard to fight and then stomp out inflation, and they did, but the price. Anyway, and since then, bonds have been on a long, slow ride down to the modern era where yields are almost nothing. It's unprecedented to have such, quote, free money, unquote, but that's where we live in the world today, with governments desperate to stimulate inflation so that they can pay off their fixed debts easier. So over the decades, bond yields have come down, and today the 10-year T-bill yields about 2 or 3%, depending on the week you're looking at it, and corporate bonds yield modestly more because they're modestly more risky. They're yielding about 4 or 5%. They're way safer, both of these, than similar stocks. That is, government bonds and corporate bonds, way safer than stocks. Less risk. So what would you expect? Less reward. And because bonds basically just boringly pay off. Only a very small handful of bonds as a percentage of the total out there ever lose money by not paying their full interest and their full principal generally on time, whereas stocks lose money all the time. So that's it. More risk, more reward. So if you've got lots of time with your investments, put it in the stock market. It's going to go up at a much higher rate than the bond market. But if you're thinking about buying a house in 18 months, well, you probably can't afford the market risk. So, sit tight.